Okay, so you want to own a car wash. Find a corner lot with heavy traffic, put up a tunnel, and let cars roll through all day at $12 or $15 a wash. It sounds like the simplest business in America. No inventory, no seasonality worth mentioning. A machine does the work, and you collect the difference. That's the pitch every roll-up video and every guy on YouTube with a drone shot of his tunnel wants you to believe. Here's the problem. If you build the business around the wash, around the $12 a car, you will lose money for years, maybe forever. The wash is not the business. It's the bait. The real business is buried under 3 layers most owners never look at. What the land is actually worth, why the $12 barely matters once the subscription kicks in, and who ends up owning the thing once the private equity money shows up. Get any one of those 3 wrong, and recession-proof cash machine turns into the fastest way to lose $4 million you've ever found. Let's start with what it actually costs to just open the doors. A modern express tunnel, the kind that pulls your car through on a conveyor while robotic arms strip it down in 90 seconds, runs somewhere between $3 and $7 million, all in. Not the tunnel, all in. Break that number apart, and something strange happens. The wash equipment itself, the conveyor, the arches, the dryers, the whole mechanical guts of the operation, is $1 to $2 million. Significant, but not the biggest line. The biggest line is the dirt underneath it. A single acre on the right corner, in the right suburb, with enough daily traffic to support the volume, can run anywhere from $500,000 to $2 million. On the West Coast, it can clear $4 million on its own, more than the entire tunnel system combined. Why does the land cost that much? Because a car wash isn't actually competing for car wash customers. It's competing with every fast food chain, every pharmacy, every coffee drive-through for the same 6 or 7 corners in a trade area that have 30,000 cars a day driving past them. You're not bidding against other car wash owners. You're bidding against Chick-fil-A. So here's the part that breaks people's brains. The tunnel, the brushes, the blowers, the whole visible machine you'd point to and say that's the car wash. That's the smaller half of the investment. The bigger half is a piece of commercial real estate you happen to be running water through. And that changes everything about how the business actually makes money, because real estate doesn't depreciate the way equipment does. It appreciates, which means the day you open, you already own 2 businesses stacked on top of each other. A wash that might lose money for the first 2 years, and a piece of land that's quietly becoming more valuable every year you hold it, completely independent of how many cars come through. You're not buying a car wash. You're buying a corner. And the wash is just what you're doing with it until the real estate value tells you to sell. Here's why banks love this business more than almost any other retail concept. It's an asset-backed loan with weather-resistant demand attached to it. A modern express tunnel qualifies for standard commercial real estate debt structures, and lenders underwrite it the way they'd underwrite an apartment building. Steady, recurring cash flow, hard collateral, low volatility. That's a big part of why capital flooded into this space over the last decade. It's not that the wash business itself got better. It's that Wall Street figured out how to price it as real estate with a subscription bolted on, instead of a small, risky local service business. That access to cheap debt is also exactly what let the industry get overbuilt in some markets. When capital is easy, operators start opening sites 18 months apart in the same trade area, instead of waiting for the first one to stabilize. 2 washes splitting the same 30,000 daily cars each do worse than 1 wash getting all of them. But the debt gets drawn either way, because the underwriting was based on the market's total traffic count, not on how many competing tunnels would eventually show up chasing the same cars. So the financing that makes this industry so attractive to build in is the same financing that eventually saturates it. Cheap, asset-backed debt built thousands of tunnels in a handful of years. Some of those tunnels are now competing 3 and 4 deep on the same 3-mile stretch of road, splitting a customer base that was only ever big enough to genuinely support 1 or 2 of them at real margin. Now here's where it gets interesting, because once the tunnel is built, almost nobody who actually understands this business is trying to sell you a single wash anymore. They're trying to sell you a membership. Walk up to a modern express wash and pay cash for 1 wash. and you'll hand over somewhere around $16 or $17. Fine, reasonable, but that's not where the money is. The number every operator in this industry is chasing is the Unlimited Wash Club, a flat monthly fee, usually between $20 and $50, that gets you unlimited washes for the whole month. Do the math on that for a second. If you remember paying $30 a month and you wash your car twice, the operator just made $15 a wash, barely different from paying cash. But if you wash it 8 times because it's free, once you've paid, the operator's revenue per wash on you just collapsed to under $4. Here's the part that should terrify a normal business owner, and it doesn't terrify a car wash operator at all. They want you to do that. They want you washing more, not less, because the actual cost of running one more car through a tunnel is almost nothing. A few cents of chemical, a few gallons of reclaimed water, no extra labor. The marginal cost of your 8th wash is close to zero. So the more free washes you take, the more the operator's fixed costs get spread across more usage, and the stickier you become. Look at Mr. Car Wash, the largest operator in the country. Roughly 3/4 of their entire wash revenue, not half, 3/4, now comes from membership, not one-time purchases. They're sitting on more than 2 million subscribers. And once someone joins, they don't leave. Industry research puts renewal intent north of 90%. Once that monthly charge is sitting quietly on your bank statement, canceling it takes more mental energy than most people will ever spend on a $15 auto draft. So here's the whole model in one sentence. The $12 wash was never the product. The product is a subscription you forget you're paying for, attached to a service with a marginal cost so close to zero that every extra use makes the business more profitable, not less. The wash is the hook. The membership is the business. Anyway, if hidden mechanics like this are the reason you're here, hit subscribe, because that's exactly what this channel breaks down every week. Now, if the marginal cost is basically nothing, where does the money actually go on the cost side? Because basically nothing doesn't mean nothing. It means the cost structure is just weighted completely differently than people assume. Take water. A single wash can use anywhere from 30 to 100 gallons, but modern reclaim systems now recover 50 to 80% of that water and reuse it inside the same cycle. A $100,000 reclaim investment can save close to $90,000 a year in water and sewer costs, a payback period of a little over a year. So water, the thing that sounds like it should be the biggest recurring cost of a business built entirely around water, is actually one of the smaller, most engineered away line items on the P&L. Chemicals run a similar story, cheap per car, but not zero, and automated dosing systems can cut monthly chemical spend by up to 40% just by not over-applying soap to a car that doesn't need it. The real cost story is labor, and it's the opposite of what you'd expect walking into a full-service wash with 20 guys drying cars by hand. An automated express tunnel runs on 3 to 5 employees a shift, greeting cars, running the register, keeping the line moving. That puts labor at roughly 15 to 20% of revenue, compared to 30 or 40% at a full-service wash where humans are doing the work the machine does here for free. Combine chemicals and labor together, and you're looking at roughly 28% of revenue at a mature site. Everything else, occupancy, insurance, marketing, repairs, is the next chunk. What's left over at a well-run, fully ramped location is an operating margin somewhere between 45 and 63%. That's the part nobody's selling you a car wash franchise deck says out loud. This isn't a service business with thin margins that scale requires you to survive. This is closer to a toll booth with a soap dispenser. And once you understand that the cost structure is engineered to shrink toward almost nothing per car, while membership revenue keeps climbing, you understand why the corner lot became more valuable than the machine standing on it. There's one more cost decision buried inside the equipment line that most people never think to ask about: friction versus touchless. Traditional tunnels use soft cloth or foam brushes that physically contact the car. Cheaper equipment, faster cycle times, but a small, constant liability exposure because brushes that pick up grit from one car can scratch the next one, and paint damage claims are a real, recurring cost line for high-volume operators. Touchless systems use only high-pressure water and chemical force, no physical contact, which appeals to owners of newer or higher-value vehicles and essentially eliminates that liability risk, at the cost of a longer cycle time, more water pressure, and more chemical volume per car. Most large operators end up running a hybrid, soft touch brushes for the bulk of the fleet, with a touchless option or a premium tier for customers willing to pay more to keep brushes off their paint. It's a small decision on the equipment spec sheet that quietly shows up on two completely different financial statements later. One in the insurance and claims line, the other in the water and chemical line. Neither choice is free. The only real decision is which cost you'd rather carry. Let's talk about the number that actually decides whether any of this works. Throughput. A tunnel 120 to 150 feet long can sustain somewhere around 100 to 130 cars an hour in real operating conditions. Not the 180 cars an hour the equipment manufacturer's brochure likes to advertise, which is a peak number nobody hits on a random Tuesday. Run that math out, and a mature, well-located site does somewhere between $700,000 and $2 million a year in revenue. A weak site, on a corner that doesn't have a traffic count to feed the tunnel, $300,000 to $500,000. Same building, same $3 to $7 million construction bill. The only difference is whether 30,000 cars a day pass the lot or 12,000 do. This is why the site selection process for a car wash looks less like picking a location and more like underwriting a bet. Operators aren't asking, is this a good neighborhood? They're asking for traffic counts, ingress and egress off a major road, visibility from both directions, and enough stacking room for 15 or 20 cars to queue without spilling onto the street on a Saturday morning. Get that wrong, and you've built a $4 million building that can never generate enough volume to cover its own fixed costs, no matter how good the membership program is. Three things decide whether a site actually hits its number, and operators underwrite all three before they ever pour concrete. 1. Daily traffic count on the road the entrance sits on, the single biggest predictor of wash volume. 2. Stacking capacity. How many cars can queue on site without backing onto the street? Because a wash that turns customers away on a Saturday morning is leaving revenue in the parking lot of the competitor down the road. 3. Membership conversion rate. What percentage of first-time retail customers actually sign up for the subscription in their first 30 days? Because a site that never converts retail traffic into members is capped at pay-per-wash economics, no matter how much traffic it gets. Here's the aphorism the whole industry runs on, without saying it out loud. A car wash doesn't make money by washing cars well. It makes money by being impossible to avoid. Now zoom out, because this is where the car wash starts looking a lot less like a service business and a lot more like something else entirely. Every single tenant retail concept chasing high-traffic corners, car washes, fast food, pharmacies, drive-through coffee, is playing the same underlying game. Lock in a location before the value of that location is fully priced in. Then let the land appreciate underneath a business that's really just a placeholder generating cash flow while you wait. This is why some of the fastest-growing operators aren't primarily obsessed with wash quality. They're obsessed with real estate. The site itself, once stabilized with a proven membership base and reliable throughput, becomes an asset that can be sold, refinanced, or used as collateral completely separately from how well the wash performs day to day. Sale-leaseback deals are common in this industry for exactly that reason. An operator sells the real estate under the wash to a real estate investor, then leases it back, pulling the land value out in cash while keeping the operating business running underneath. So the ownership structure of a mature car wash portfolio often isn't one business. It's two, stacked on top of each other and owned by two different sets of investors. One owns the dirt. One owns the subscription base and the equipment running on top of it. And the dirt owner doesn't care if wash volume dips 10% this quarter. Their return doesn't depend on how many cars showed up. It depends on the corner still being a good corner in 15 years. This is the same trapdoor that shows up underneath casinos, malls, and hotels. A service business sitting on top of a real estate bet, where the operating business is the story you tell and the land is the reason the numbers actually work. Here's where it actually goes wrong, and it goes wrong in one of two very specific ways. Scenario 1, you get the real estate right and the membership wrong. Great corner, 30,000 cars a day, land that's already appreciating, but the site never converts retail customers into subscribers. You're stuck running one-time washes at $16 a car with a labor and chemical cost structure that assumes membership volume, subsidizing everything else. Revenue looks fine on a good weekend and collapses the moment weather turns, because you never built the recurring base that makes weather irrelevant. Scenario 2. You get the membership right and the real estate wrong. You've built a beautiful subscription base, 90% renewal, customers washing 8 times a month for $30, on a corner that only sees 12,000 cars a day instead of 30,000. The tunnel that can sustain 100 cars an hour is running at a third of capacity. You've built a Ferrari engine and put it in a car with no room to accelerate. The membership economics that look incredible on a spreadsheet never get the volume to actually compound. Either mistake, on its own, is survivable for a while because the underlying real estate is quietly holding its value even while the operating business struggles. Together, they're why so many first-year builds miss their own pro forma. Not because the model is broken, but because most first-time owners can only see one half of the equation while they're building it. Which brings us to the part of this industry that's actually reshaping it right now: consolidation. The U.S. car wash industry is worth an estimated $15 billion, and it's still deeply fragmented. Thousands of independent, single-site owners who built one wash, ran it for 20 years, and never expanded. That fragmentation is exactly what private equity looks for. Here's the mechanics of the play, and it's worth understanding because it's the same play running across dozens of boring industries right now. A private equity-backed platform, names like Mr. Car Wash, Tommy's Express, Tidal Wave, and Whitewater Express are the biggest examples, goes out and buys small, independent operators at a valuation well below what the assembled platform will trade for once it's integrated. Once that site is absorbed into the platform, rebranded, plugged into centralized membership software and bulk chemical purchasing, the whole platform trades at a materially higher multiple than any single site would on its own. Buy low, fold in, and the blended value of the platform is worth more than the sum of what you paid for the parts. That gap between the buying multiple and the platform multiple is the entire return. Mr. Car Wash is the clearest case study in the country. It went public in 2021 at close to 25 times earnings, an eye-watering multiple for a business that washes cars. By 2026, that multiple had compressed to roughly 7 or 8 times because public investors couldn't reconcile a business that looked high growth on the outside with earnings that stayed nearly flat, since every new, unramped location dragged down the company's blended margins, even while individual mature sites stayed extremely profitable. The company has since moved to go private, not because the underlying site stopped making money, but because the public market was pricing the whole platform on the wrong metric. Away from quarterly earnings pressure, the same operator can now buy up smaller regional chains more aggressively, at whatever multiple actually reflects each site's long-run cash flow, rather than whatever number keeps a stock price stable. It isn't only private equity platforms doing the buying. Other multi-brand strategic consolidators like Driven Brands, which already owns oil change and collision repair chains across the country, treat car wash acquisitions the same way, another recurring revenue vertical to bolt onto an existing customer base and back office. Whether the buyer is a PE-backed platform or a strategic acquirer with a dozen other automotive brands, the logic is identical. A fragmented, cash-generative, real estate-backed industry is exactly what gets bought and rolled up. So the person who thinks they're getting into car washes by building one tunnel on one corner is actually a small supplier in someone else's much larger game. Build well, run it clean, hit your membership numbers, and in a few years, you're not necessarily an owner-operator anymore. You're an acquisition target, and the multiple you get paid depends entirely on whether you understood this game while you were still small enough to be bought. Let's put every number in this video into one site and see what it actually looks like. Say you build a $5 million express tunnel on a corner that pulls 25,000 cars a day. Solid, not spectacular. At 110 cars an hour sustained, running 12 hours a day, That tunnel can physically process well over 1,000 cars a day if demand were unlimited, but real demand caps it far below that ceiling. A well-converted site gets maybe 60 to 70% of its washes from members paying $30 a month, the rest from retail customers at $16 a wash. Blend that mix, subtract labor and chemicals at roughly 28% of revenue, subtract occupancy, insurance, marketing, and reclaim system upkeep, and a mature version of that exact site lands in the 50 to 60% operating margin range. Call it $1 million or more of annual cash flow on a $5 million build. That's the number a private equity buyer is underwriting when they show up with a term sheet. Not the car wash. The $1 million recurring real estate-backed cash flow stream sitting underneath it on a corner that's worth more today than the day you bought it. So who actually wins in the economics of owning a car wash? Not usually the person standing in the parking lot watching cars roll through the tunnel. The land under a good corner appreciates whether the wash performs or not. The subscription model turns a $12 transaction into a recurring charge nobody thinks to cancel. The marginal cost of each wash is engineered down toward nothing, so growth in usage adds almost pure margin. And the entire structure is built to be rolled up, rebranded, and resold to a platform that gets a better multiple than you ever could standing alone. The wash itself, the brushes, the foam, the 90 seconds of spinning cloth, is the only part of this business the customer ever sees. It's also, by dollar value, one of the smallest parts of why the business actually works. You didn't buy a car wash. You bought a corner, a subscription engine, and an eventual exit to somebody with a bigger balance sheet than yours. And the $12 wash was just how you kept the lights on until all three of those started paying you at once. Now here's the thing about that stack structure. Land underneath, subscription running on top, eventual consolidation buyer at the end. That pattern isn't unique to car washes. It's the exact same blueprint behind one of the most capital-hungry asset classes on Earth right now, and the numbers involved make a $5 million tunnel look like pocket change. Somewhere in a nondescript building surrounded by chain-link fence, a single facility can cost more to build than an entire car wash chain, and the company running it might not even be the one that owns the land, the power contract, or the servers inside. In the next video, we're pulling apart the economics of owning a data center. Who actually owns the dirt? Who owns the electricity? And why the company whose logo is on the outside of the building might be the party taking home the smallest cut of all.